we might get started. So if anyone's turning up late, we've already got quite a number now. They can always watch the recording. So welcome. Thanks very much for joining us. We've got an update today. We just thought it was quite relevant, as we all see at the moment. The government clearly need money. And I guess what we've been hearing from the government at the moment is they want to focus on those, those multinational companies that seem to be taking all the money, and that seems to be going to be the resolution for their money shortages here in Australia. So we did expect quite a bit more to come out of the budget, but still some interesting areas that have come out. And also we want to touch on some of what we've been seeing, I guess you could say, on the ground with what the ATO has been looking at doing. So I'll start and get going as well. Okay, just for those that have joined us, probably half on the call today have been either clients or working with us, and the other half we haven't yet got to know you. So just to give you a bit of background about transfer pricing solutions, we are a boutique practice specialising in transfer pricing. Hence the name, I guess you could nearly say. But we do like to focus on the fact of really giving practical, proactive and really cost-effective advice on what we're actually looking at, all being specialists and all high-level practitioners within our team as well. We've been around actually this year. We celebrated our 15th birthday, so we have been around quite some time. As well, we have our office where we started here in Australia. We expanded, it would be about 5 or so years ago, into Singapore. And Adriana heads up in Singapore, and then we also have our office in Malaysia, which must be nearly 3 years old, I think, at this point. HC spends his time half in Malaysia and half in Australia, although he is a kind of Australian Malaysian, I guess you could say, HC. So he kind of gets the opportunity of going back and forth. I'm sure he just loves it because he gets to go back to Malaysia all the time. And now post-COVID, now you can actually get back there a bit more. We have been recognised for our expertise, not only with a number of awards here in Australia, but also internationally with the International Tax Awards. And one of our biggest, I guess, what we're really proud of is being recognised as what they call a Tier 2 transfer pricing advisor up there, as you can see in that listing, with a lot of the big firms. So we're really pleased with that. Acronym. So myself, my name's Shannon Smith. I'm the founding director of Transfer Pricing Solutions. I also have with me today Kevin Tay, who's a senior manager. Kevin's been with me a number of years. He was here for about 4 or so years. Then he thought he'd go to one of the big 4 for a few years, and then now came back, and he's been back a few years with us. So he couldn't keep away. And HC, who's also a senior manager, as I mentioned, is kind of spends his time between Australia and Malaysia as well. So today what we wanted to cover is what came out of the budget last week. We also want to touch on some of the key focus areas that, as a result of what came out of the budget, what we see and what we think you need to make sure you're aware of, and what the risks are in relation to the MOLA and country-by-country reporting. They are areas that we often see people overlook when going through their tax returns. And then we want to touch on the transfer pricing cycle and its importance for adjustments. And we're seeing that that's going to become a lot more important now that we have a tax authority who is incredibly active at the moment. We've been seeing that over the past few years as well. But I think with what's come out of the budget, we're going to see a lot more coming out as well. So some of the highlights from the budget, I know that there were a lot of people that said the budget was a bit of a non-event. Some of the highlights from an international tax perspective, and those that will impact from a transfer pricing perspective, was thin capitalisation, intangibles, transparency, and now the ATO is going to be really cashed up for some audits and reviews. So I'll just go through those in a little bit more detail. Now, we don't have all the information at this point in time, but we will get more as it comes along. But looking at the thin cap rules, basically what they're looking at is that they're going to potentially limit the amount that can be claimed for debt deductions such as interest, and that potentially they're going to amend those particular rules. So the government wants to replace what we've had in place now, the current safe harbour and the worldwide gearing tests, with, they want to kind of substitute that for a earnings-based test to limit the debt deductions in line with the entity's profit. So in the past, we've had these other rules. Now that they're actually wanting to say, well, multinationals operating in Australia, whether it be inward or outward investor, in relation to the thin capitalisation, they want to limit the entity's debt deductions to 30% of the profit. So using EBITDA as the measure of profit, And so that earnings test is expected to then replace the safe harbour test. So looking at limiting up to the 30%. They want to allow deductions denied under the entity level EBITDA test, so interest expense amount exceeding the 3% EBITDA test ratio, and to be carried forward and then potentially claimed in subsequent periods. There's talk of that being up to 15 years. And I've gone ahead of myself. And then also allowing as an entity, allow an entity as a group to claim a debt deduction up to the level of a worldwide net interest expense as a share of their earnings. So that may exceed the 30%. So that's a new earnings-based group ratio that they're looking at using to replace what we call the worldwide gearing ratio. And then retaining the arm's length debt test. Now, there was talk before the budget of that going, but they're actually talking about retaining the arm's length debt test as a substitute test, and that will only apply to the entity's external third-party debt and disallow deductions for related party debt under this test. So what we're going to see is, I guess, kind of the change being the safe harbour, that's going to be gone and replaced with our 30%. There is going to be some difference in the application of the arm's length debt test, not having that from a related party, only for third party, and then also a change in the worldwide gearing. So some of the debt to equity ratio test on that. Now, what that means from a transfer pricing perspective, we have the thin capitalisation rules and we have the transfer pricing rules. And when we're looking at it from a transfer pricing, we're looking at pricing the debt, making sure it's at arm's length. So there's going to be some interaction on both of those sides, especially when we start having the change in the way in which the 30% factor coming in. So there will be more details, no doubt, to come from the tax authority on it, but not at this stage. Intangibles. Now, this one was talked about quite a bit before the budget, but they did it. They went ahead and did it. What they're looking at doing is deductions may be denied for payments into low tax jurisdictions. There's also very unclear on the definitions, and then businesses with international related party financing will probably be the most impacted on it. So basically looking at significant global entities, so those with at least 1 billion of global revenue, they'll be no longer able to claim a tax deduction for payments made directly or indirectly to related parties for intangibles that are held in low or no tax jurisdictions. Now, you would have seen, years ago, I remember clients many, many years ago all saying, oh, we're trying to move our intangibles off to, a certain location, low tax, no tax. If you have the intangibles in those locations, basically what we're looking at here is that there'll be actually no deduction. And so this will include royalties paid for the use of trademarks, but also other intellectual property items. And a low or no tax jurisdiction will be one that has a rate of tax of less than 15%, or a tax preferential patent box regime without significant substance. So there are a number of tax authorities around the world that have this patent box regime that's really going to be focused on what's the substance? Is it just a box, or do you have the substance around that to support it? It's anticipated to apply to payments made on or after 1st of July 2023. So this is where it's going to be really important for businesses to have a look at their structuring, have a look where they've got their IP, do they have substance behind that, and kind of proactively manage how are you going to deal with this from a post 1st of July 2023 basis to ensure that you've still got a tax deduction ideally from that as well. And then we're looking at transparency, and that was another key theme that came through. There will be additional compliance burden for the country-by-country reporting entities, and this will be in line with the global country-by-country reporting measures. So basically, from 1st of July 2023, companies will need to declare their subsidiaries and the country of tax domicile as well. So that's going to be one that will mean that there will be a lot more further information that's going to be required to come through from that perspective as well. Not too much more on that. There are some in with the transparency also around the tenders with government tenders. That doesn't really kind of impact the transfer pricing side so much, but there is a bit more that came out from that side as well. So multinational business and the tax avoidance task force. Now, this task force has been doing really, really well. They've been getting a great return on their investment, money invested by the government so that they can go out and review taxpayers. And if we look at the revenue return, I was speaking with one of the someone from the ATO that was presenting him with my uni presentation, and they were actually saying that they were getting, for every dollar invested, they were getting $6 back. For every dollar invested, we're getting $6 back. Now, there's been further funds, because remembering the federal government have been talking about these multinational companies need to pay their fair share of tax. So that's been a real focus point for them. So there's additional funds that are going to be going to the tax office so that they can more actively have a look and review these situations. So we wanted to touch on a bit today and go through what are some of those areas that we're seeing activity from the tax office, and also seeing probably you could nearly say lack of activity from the taxpayer, whether it be from the taxpayer not realising that they should be considering that, or from the tax agent not realising that they should be considering it. We just want to make sure that you are aware of these different areas and what is the risk and exposure that you might have, especially given when you are going into a review, you want to make sure you're going into that with a reasonably arguable position or having documentation in place. So we're going to touch on those. So I'm going to hand you over to Kevin.
Thanks, Shannon. Thanks for the update. Now, let's look at what it all means, in terms of the key focus areas. Now, over the past few years, or actually over the past 2 years, we've seen many activities and development on the key focus areas, like your hybrid mismatch, your multinational anti-avoidance law, intercompany financing, country-by-country reporting. And with this budget, what we really expect is there's going to be more ATO reviews in these key areas moving forward. Okay, but let's first look at the hybrid mismatch rules. Now, we have done a full webinar on this topic in the past, and you can still access that in our YouTube channel. So if you're interested in the details, go hit up the YouTube channel, give us a like if you like the video. But just a brief overview, the hybrid mismatch rule is Australia's response to the OECD recommendations for neutralizing hybrid arrangements. And it applies on or after 1st of January 2019 income year. So since then, the ATO has released multiple guidance to help taxpayers interpret the rules. In general, but what you need to know just in general, the hybrid mismatch rule aims is to eliminate double non-taxation outcome arising from hybrid arrangements. This can be either hybrid financial arrangements. For example, you have a financial instrument, let's say it's a loan, that give rise to an interest which is treated tax deductible in one jurisdiction, but not in the other jurisdiction. Or it could be an arrangement arising from dealings with hybrid entities. So for example, you have an entity that is treated as a pass-through entity in one jurisdiction and not on the other. This is very common when you have a US parent entity that has made a check-the-box election for a subsidiary in Australia. In fact, we actually have a few clients that have this issue. During the year, I think just during these past 2 years, we've got a lot of cases where, client coming to us asking whether or not they need to be worried about the hybrid rules, because they have a US entity, US parent entity that has made the check balance. What this means is basically the tax deduction that they claim in Australia is tax deductible, but they are treated as a pass-through entity in US, and in the US side they are claiming the same tax deduction. So you have ending up with a double deduction scenario. Okay. So just to give you an idea, we have a lot of questions on that. Some of them even got reviewed by the ATO. And the most recent case where we have an entity that we have a client that got about close to $1 million tax deduction denied as a result of the hybrid mismatch rules. Okay, so what happens if you get caught under the rules? Okay, 2 scenarios in general. Either you will have your tax deduction in Australia denied, or you will have an amount that are otherwise non-taxable to be included in your taxable income in Australia. So the two. So basically, what they do is basically they neutralize your benefit out of the hybrid arrangements. Okay. Some of us might ask, who really is at risk here? Does it relate to me? I think a few things that you need to look out for in this hybrid mismatch rules is whether or not your arrangements with your offshore related parties will give rise to hybrid mismatch. Like I say, hybrid mismatch, let's think about whether or not you have deduction in 2 or more jurisdictions for the same payment, whether or not you have claim a deduction, but that deduction is not taxable in another jurisdiction. That's a good starting point to self-assess. Second, are you aware of the hybrid mismatch? Do you know that this? Have you done your due diligence to ask around with your group whether or not you have this arrangement that links to you, either directly or indirectly? And then thirdly, have you actually received a benefit from the hybrid mismatch? Because like I always say, no harm, no foul, is it? Because if you're not gaining anything from it, even you got review, the net outcome is there's not going to be any adjustment, right? Okay, like I say, this is a very hot topic, I would say. Just this year itself, the amount of queries we receive just on hybrid mismatch rule has doubled from last year. Some are due to the client or their tax agents, they are not aware of whether or not the rules applies to them. Some are just because they were reviewed by the tax office and they need help. Okay. Other than that, so some of you may have noticed when you fill in the international dealing schedule, they have a question 45 which asks you to disclose whether or not you have assessed whether the hybrid mismatch rule applies to you. Now, what this tells us is basically ATO is keeping track of multinationals related to the hybrid arrangements. So we will expect this to continue to be a key area scrutinized by the ATO in the coming years. Okay, so the next one, let's go into MAL, the Multinational Anti-Avoidance Law. This is a little bit older in the sense that it was introduced in 2015 as part of the BEPS initiative. We can go to the next slide. Yep. Well, again, we also have a full webinar on this. Go to our website, have a look at the videos. If you like it, give it a thumbs up. So briefly speaking, MAL was introduced to combat erosion in Australia, tax base, and it applies after 1st of January 2016. However, different from the hybrid rules, MAL targets a very specific structure that are put in place for multinationals to avoid taxable presence when selling products or providing services into Australia and booking all this revenue offshore. Okay, structure that are set up for the purpose of avoiding tax in Australia or reducing their foreign tax liabilities. Okay, give you an example. You have a local entity doing all significant high value sales functions in Australia. Now, this includes sales and marketing functions, contract negotiating, signing contract on behalf of an offshore related parties, while these offshore entities is selling directly to the Australian customer and booking the revenue offshore. Okay. Now, these are the structure that that generally targeted by the MAL. Okay. If you are caught under the MAL, ATO can you go to the next slide?
Sorry. Yeah.
Sorry. So if you're caught in the MAL, ATO can deem all income earned by the offshore entity as if they are earned through an Australian permanent establishment and tax accordingly. Okay, but thankfully, MAL, like I say, MAL apply only on very specific conditions. First, you have to be a significant global entities, meaning you have to have a global consolidated turnover of above AUD 1 billion. Okay, your scheme or your transfer pricing structure have to have 3 of these key characteristics. It was put in to avoid taxable presence in Australia. It was put in to shift income to a foreign resident and to obtain tax benefit. Now, there's a framework on how you can work out whether or not your scheme includes all these 3 points. we also discuss it in the YouTube channel, so have a look. But if you have, or if you are not sure and you have one or few of these key points that applies to you, speak to us after the call, after this webinar. We are happy to work through the details with you, and maybe come up with solutions. Okay, so that wraps up Mal. I'll pass on to my colleague Hong Chuan to talk about the country by country reporting aspect.
Thanks, Kevin, for introduction of the hybrid mismatch and Mal. So now, I guess further to the budget, we would like to focus on, as well as the CP country by country reporting, where the government has actually spent additional funding on, right? So to the next slide, country by country reporting, actually it applies to entities that have consolidated revenue above 1 billion, or part of a group with consolidated revenue above 1 billion, right? The important part is obviously there are a lot of taxpayers that do not fall under that consolidated revenue of above 1 billion. But the important part here is that if you are part of a group with consolidated revenue above 1 billion, then you have to be aware of this, right? Based on our experience, there are a lot of foreign and owned entities that are caught off guard when it comes to CBC reporting, because they're unsure whether they actually fall within the country by country reporting purview, right? Hence, it's actually very crucial that you perform a CBC assessment to make sure that whether you fall under CBC reporting or not, especially when you go through your international dealing schedule in the income tax return, right? So what is CBC reporting, right? So it incorporates revised standard for TB documentation. It provides a common template for SGEs, significant global entities, or now they have been renamed to country by country reporting entities, to report income and other measures of economic activities. So that's under your CBC report, right? It also involves the activities, the principal activities, the jurisdictions in place. So basically, it's sort of a high-level overview of all the entities within the group, right? So on top of that, so CBC reporting statements, they adopt a three-tiered approach, which are your CBC report, your master file, which is like a blueprint of your group, and then lastly, local file, right? So in Australia, the local file is actually not your transfer pricing documentation. That's a misconception here, which really it's a discrepancy apart from OECD, where the local file is the TB documentation. In Australia, the local file is more towards a more detailed international dealing schedule, right? So it consists of short form, part A and part B. So you have to make sure that you're aware of whether you fall under the CBC reporting. And the reason why that's the case is because the penalties on the next slide is actually very hefty, right? So the penalties for CBC reporting in relation to the failure to lodge the statements, the CBC reporting statements, it goes from 100,000 to a cap of 500,000, as you can see illustrated in the slides here from the ATO itself, where if you fail to lodge, you could pay upwards of 500,000, right? So that it depends on the date delay. So it's actually pretty hefty. And previously the ATO was pretty lenient on lodgement, as the country is actually transitioning into the CBC reporting concept back in 2016, and now we're in the 2022 now, that the ATO is scrutinizing taxpayers on the lodgement much more closely, right? So please make sure of your deadline, which is 12 months after your income year, right? So, and if there are any delays, it will be prudent to actually liaise with the ATO before the deadline. At least you have that email and black and white in place that reasonable effort has been performed to liaise with the ATO for any potential extensions, right? So once that's put in place, at least depending on the outcome, right? So we have reasonable effort to show that we are, requesting for an extension if possible, right? So make sure that you look at the deadline and lodge on time, right? So I guess we have gone through, the budget. We know that there are additional budget, funding in place. So the next phase is to look at, our transfer pricing cycles, right? And, importance of adjustments and audits, right? With the budget in place, it will be good to go through a TP cycle or process so that you could be audit ready should it arise. It's very important to keep in mind that TP is as important as other areas, be it tax or audit. So it's going to require, education within the organization so that key stakeholders are actually aware that there will be risks involved, which needs to be managed as part of the governance for the group itself, right? So we need to make sure that everyone should be aware of transfer pricing, right? So usually when managing TP, a lot of companies focuses on, your compliance work, which is equally important, your TP documentation, especially when transaction has already occurred and the books have closed, right? However, the actual preparation actually starts from for reviews and audit should start when the company enters or plan to enter into the related party arrangement. So once you're aware that, within the business strategy that you're going to have related party transaction in place, that is when you should start planning how to go about charging that related party transaction. So it's important to have that awareness and understanding that TP is the risks that needs to be managed as part of your tax and international tax risks, right? So the best way to understand your TP arrangement is by going through the stages of the TP cycles closely. So if you look at the slides here, it goes from planning and policies, then to your pricing, setting and contracts, then implementation on transaction and journal entries, after which you test and comply, and then monitor your policies and framework. And lastly, should it come to controversies or litigation, audit ready, you're able to actually provide the relevant documentation to the ATO, to minimize your TP exposure. Now, generally, majority of the taxpayers would have started at the testing and compliance stage, which is like the fourth stage, where your transaction has already occurred. And what we have experienced so far is that there is a direct correlation between the success rate of an audit and going through the TP cycles from the planning stage. Hence, it's very important to plan your TP arrangements accordingly. Now, let's start with the TP cycles in more detail. Right, the first phase, right, is planning and policies, which ideally is where the process should commence. Right, a TP policy is put in place, which sets out the group's TP framework overall. And some of the questions that you need to ask yourself is, what's the company's stance or approach in TP, and who is responsible for TP within the group? Right, you may have your local or regional person in charge, where personnel within the organization, when they are aware that there are TP issues in place, who should they find and sort of rectify the TP issues with? How
Are you there, HC? It seems to have frozen. Let's give HC a minute. You there, HC? Okay, well, I'll jump in while HC's frozen. At least his pose isn't too bad. It could have been worse when you get frozen on Zoom. So you're looking at your transfer pricing policy, and it sets a framework. How does the company approach transfer pricing? As HC said earlier, often we get it where clients are going straight into the transaction and testing side of things rather than actually planning. Now, when you've got the opportunity to plan up front, who's going to be responsible? So not only responsible for the documentation, but who's responsible for making sure that the transactions exist? Oh, you're back, HC. I'll finish on this one and go on to the next one. You at least froze in a decent, you're a decent pose of when you froze. It wasn't too bad. So you didn't have your mouth open or anything like that. Looking at when you look at the policy, how is the arm's length standard going to be applied? And how does that align, most importantly, how does that align with the business model and the overall strategy of the business? Because you're not in business to do transfer pricing. And I know over time, we've come across clients that have implemented transfer pricing structures that have really, when we've actually started to meet with management, et cetera, have no correlation of what they're operationally doing. So it's important to make sure that your transfer pricing policy aligns with your business model and the overall strategy of the business. So I'll hand you back then to HC, who's out of frozen. It was like out of frozen mode onto price setting and contracts.
All right, apologies for that. I think the internet is not working in my favor. So yeah, thanks, Shannon, for explaining the planning and policy stage. Now, I would like to emphasize that before we go to price setting, that TP planning is crucial, so that if your TP framework is done properly, then everything else will fall in place as long as everything is implemented accordingly, right? Important thing is communication. So communication is key, where everyone in your organization should understand that there is a TP framework in place and that it complies with the arm's length principle, right? So that's where the communication lies. Now, to the price setting, right? So once you have your TP framework in place, then the contract should be formalized based on your arm's length price that has been benchmarked, as well as other terms and conditions that should be put in place. Now, it will only be formalized when both parties sign the contract, right? It's important to show that the negotiation process has been put in place between parties with evidence, right? You have your evidence such as your minutes of meetings, emails, right? Because these can be requested by the ATO to ensure that the process has been put in place. Now, lastly, the contract is not just a document that you sign and then you leave it somewhere else and be forgotten. It should be reviewed annually to check whether there are any changes to the business operations, changes to the pricing policy or terms and conditions, right? So that's where there are any changes in place, then the contracts as well as other documentation should be re-looked at and then updated accordingly, right? So that's where you have your price setting and contracts. And then the next phase is that, so we have form and substance, and the contract and TP policies are more of the form. And when we have the form ready, now that we have to make sure that the substance would be put in place. That's where the implementation comes in, right? So the implementation phase is to make sure that you have what you have implemented ties back to your contract, right? More often than not, we see cases where the TP policies or documentation are correct, are accurate, but there are a lot of discrepancies between the invoices, contracts, and TP documentation, right? You may have your errors in markup or errors in distribution margins. So this is important because the ATO will request for these documents, invoices, recordings, your TP policies or documentation. Their expectation is that all these should be consistent throughout, right? So otherwise, you are essentially providing more areas for the ATO to scrutinize. Now, recently, we had an ATO review which did exactly this, right? They've gone through in more detail to the work papers, the journals, the trial balance, to cross-check what has been charged against what has been implemented, right? So basically, I have a cross-check team to go through your journals against your work papers to make sure that everything is aligned. If it's that there are inconsistency, then they will have more questions to ask, right? So the good thing is that the taxpayers have gone through the planning stage to the implementation phase and actually follow it accordingly, right? Everything has fallen into place. Then we had all the work papers in place for the review, and there are no other information to be requested by the ATO.
Yeah, and that's a really good one to point out and emphasize, HC. I mean, that what we see time and time again when a taxpayer goes into a review and we get the call and they say, oh, we had, whichever firm it was, do some transfer pricing documentation, years ago, and here's our benchmarking rate. And actually the rate can be, you would hope that the transfer pricing advisor doing the benchmarking gets the rate right. You would hope. You'd say majority of the time it should be right. But what the big challenge that, HC was just highlighting is the fact that, in not so many clients that we get that come on that have, are getting reviewed, no one's actually bothered to go back and implement it properly and make sure, like what HC is saying, that the mapping's coming through and all of that. So anyone listening today, if that's not something you've done, you've got your glossy TP report and you're like, great, I've got my report and I'll put it on the shelf. That's only a little part of the story. You need to make sure you've gone through on the detail. And I guess that's one thing that we always pride ourselves at TPS is that we're not only, just doing the report, we help implement and make it operationally happen. And I think that's, what HC's been spending quite a bit of time with one client who's over $1 billion client, and the ATO has been going through it all, and we have all of that supporting implementation documents. We can go right down and down and down into the ledger and keep going down. But that took a few months of, we had the data there, but to walk the ATO through it all, and I'm glad we did, because there would have been huge challenges had they not done that at the beginning when they did the planning. So it's a really good point, HC.
Yeah, thanks, Shannon. Yeah, I think imagine if there are no work papers in place or everything is not followed accordingly, then it will take a lot longer time and a lot of scrutinization in place. So please make sure that when you implement things, you have to implement according to your policies or framework, right? So now after the implementation, right, everything is put in place, journal is done correctly. Then we have the testing and compliance, which is the next phase, which is more towards what we are familiar with, right? So which is the preparation of TP documentation that tests the pricing of the transaction, right? The idea is that this testing is performed at the same time of entering into the transaction. If you go through the TP cycles accordingly, the reason for this is that to make sure that if any adjustments are required, then they can be done before closing of the books or before lodging the tax return. Some companies follow good governance and perform the benchmarking analysis and documentation when they enter into or going to enter into the real party transaction and set the price based on the study to make sure that adjustments are not required, right? So it depends depending on circumstances. Now, as part of the interviews, right, we conduct, it was good to know that a lot of head of taxes, I think they've gone through the phase where doing nothing is no longer an option, and they have to be compliant with TP, and arm's length principle has to be implemented within the organization. And recently, based on our experience as well, that there are quite a few taxpayers that were not able to provide contracts, or they do not have any contracts in place, right? So it's good to have a contract in place, because that is one of the documents that we requested by the ATO. And if you do not provide these documents, then it does not provide confidence to the ATO that the taxpayers has good governance in their TP, right? Once you've had that in place, then ATO would have that mindset, then it's almost certain that you're likely fighting a losing battle, right? So if you have that mindset for the ATO. So we have to make sure that we have tested properly and comply and have all the documentation in place should the audit review arise. And the next slide, I just want to briefly go through, like, there are certain approaches to, testing and compliance. there are two approaches. One is the ex ante, which is at the time you enter into a transaction, and then second, which is the ex post, which is after the transaction has happened, which sometimes completes it. And when ex ante means you have tested your transaction when you enter and know that it's arm's length, and ex post is only when on the testing phase, then only you test your transaction on an economic analysis after it has happened, right? So in the next slide, the ATO stance in relation to contemporaneous is that the TB documentation needs to be ready before the lodgement of your tax returns, right? Which includes your international dealing schedule, where taxpayers are required to disclose their international related party transaction details only when it's more than $2 million. But having said that, even though you are below $2 million, does not mean that you're not required to make sure that it's arm's length principle. You're just not required to disclose it, but you need to make sure that your transactions are still at arm's length, right? And the details in the international dealing schedule reflects the analysis performed in the TB documentation. So you have your value, you have your percentage of dealings, and then you have the methods used to test, right? So these needs to be disclosed in the IDS, right? So in this regard, the TB documentation needs to be prepared prior to the lodgement of your tax return, right? So that's the key part here. Now, after you have gone through your testing, you prepare your TB documentation, everything is done properly, you have the contracts. Next phase is monitoring, right? So as I mentioned earlier, you don't just do it once off initial investment, then just be forgotten. TP needs to be monitored constantly. So the question is that we have asked so far is, are annual reviews mandatory? Do we need to do annual reviews, right? We understand that the biggest effort in preparing the TB documentation is generally for the first year, where it has been prepared from scratch, and then once it is completed, it should be maintained every year. Now, if the business does not change, if there are no changes to the business operation, the expectation is that you still need to relook and update the financial information of your comparable companies. If you use benchmarking searches, if you have used other methods, it still needs to be looked at on economic analysis to make sure that up-to-date data are used to test. But the rest of the documentation can remain the same, generally with your facts, your business factual fact patterns in the documentation, right? Sometimes it can be as simple as adding an addendum to show that, okay, this is the original documentation, then you have changed the financials. And in terms of the benchmarking searches, right, new searches are expected to be performed every 3 years. Right, so you have your year one benchmarking search, then year 2, year 3, then you can update the financials. Then from year 4, then you need to perform a new search again, right? And this is when there are no changes to the business. If there are changes in the business, then it is key to then update your documentation should any changes arise. More importantly, if there are any material changes to the business, then the TB documentation then should be reviewed and revised according to the business change, right? Now, gone to the monitoring. If you follow closely the TP cycles, then it should minimize your TP exposure significantly. Now I've gone through the TP cycles, then let's look at, what are the common areas of disputes that may be faced during an audit. Right. So these are the common areas of disputes that we have experienced so far, right? First up is, lack of substance. Are there any issues with incorrect characterization? Whether your entity, the taxpayer, is actually characterized as is it low risk, medium risk, or is it entrepreneur, right? Then there are issues with mismatch of substance over form, as we have mentioned earlier, where what you have implemented, is it consistent with your contracts, right? So that's important. Sometimes we have taxpayers that have no contracts in place. So it's important to have contracts in place to actually formalize your real party transaction or arrangements. Then next is incorrect pricing or incorrect implementation, right? So we have faced pricing or margin that are not supported by benchmarking, for example, or you need to have other methods to actually test your pricing or margin. Then sometimes pricing and margin are not defined accurately or not delineated properly in your contracts, as opposed to your TP documentation. Then there are circumstances where taxpayers do not monitor their TP documentation, so they have their TP documentation prepared, and then they just leave it as it is, and then there are changes to the business operations and pricing has changed. So this would lead to different pricing. Then ATO come in and adjust accordingly. And the third one is recurrent loss makers, right? So now we're in the COVID phase, or rather getting out of the COVID phase, where then previously during the COVID, maybe loss makers can be substantiated using the COVID impact, depending on your industries. But now we're coming out of the COVID stage. So companies or taxpayers with recurrent losses in combination with high value real party transaction, you need to really relook at why you're making losses. Making losses doesn't mean that you're not doing a transfer mispricing, but you need to look at what is affecting, what kind of commercial reasons are affecting your business to make you loss-making in the first place. Then we have choices of comparable companies, right? So in Australia, we need to look at what kind of comparables are being selected, right? Some jurisdiction, they prefer local. ATO is obviously local is preferred, but then it can be broadened to other regions, APAC, for example. And then ATO tends to look at whether they're able to reject comparables that are loss-making, for example. So please relook at your benchmarking analysis. And then in terms of arm's length range, generally accepted range is actually the interquartile range, which is the 25th to 75th percentile. If you are situated within the 25th, the lower quartile and upper quartile, that's fine. But it's prudent to relook at what your margin is, right? It'd be good to use the median point as a guideline, when setting your pricing, your margin, to make sure that, if you put in use the median as your guideline, generally speaking, the median should fall within the interquartile range next year as well, right? So that's one of the reasons why we use the median. And then we have TP adjustments. TP adjustments generally allow before closing the books. So we need to make sure that through your TP policies or framework, when you want to perform in true up, true downs on your TP adjustments, it's good to look at before closing of the books, because any retrospective adjustments can be challenging and may affect other areas of tax as well, right? So we do keep that in mind. So these are the component areas of disputes that we generally face. Then the next slide, just want to close off, is what are the common information that are generally requested during an audit or review, right? First up, your contracts, right? That's very important. TP documentation, obviously. Then we have your org chart, which should be in your TP documentation. Then more importantly, the invoices, the trial balance, the work papers behind your TP policies, right? So the ATO wants to make sure that, okay, you have the work papers in place, you have TP documentation in place. Then I want to look at whether you have actually implemented it accordingly, right? So once they've done that, they will go through your methodology, right? Whether you have any support to your pricing methodology, what's the basis for the pricing of your transaction, right? These are the common information that generally will be requested. So as I mentioned so far, once you've gone through the TP cycles, you would have all these work papers, documents in place should the audit arise, then you're more or less just providing them those documentation and be more at ease, right? So yeah, that closes my part.
Thank you for that, HC. I think actually Kevin and I got out of this webinar quite easy, not having to talk as much. I think we must have just been a bit, HC can do that and you can do this and handed it over. So thank you for all of that. So what are some of the key takeaways? We've got a new budget in place. We have a government that wants some money and has a big gap. Now, there's a lot of promises that came out of the budget. And I don't know if anyone looked at then the table of the increase in debt over the next few years. So, they need to pay for that. And, apparently it's all these multinational companies that need to help with these budget measures. So from your perspective, what can you do if you're the accountant for your clients or you are with the company? Make sure that you've got your transfer pricing documentation in place, that you've gone through the planning processes, that you've considered these other areas, you've considered the hybrid mismatch, don't ignore it on your tax return, you've considered the MOLA and the country by country reporting, and start proactively planning that. A lot of people do tax planning at a very high corporate tax level, but not always are they incorporating their transfer pricing into it. That is going to be more important than ever, especially as it relates to the thin capitalization. If you're not now going to have a limitation on your debt deduction, how can you do your tax planning and actually plan out what your effective corporate tax rate is going to be if you haven't done your overall tax planning and considered the implications of what's going to happen come 1st of July 2023? I would be suggesting that in a few months into the new year, I'd be saying January, February, March, plan that out. Do a tax planning as you might do personally. I would be looking at doing that for your business to understand where are you going to land, and is that going to be the answer that you want? And if not, how can you look at the structuring, whether it be speaking to your subsidiary, speaking to your parent company, to make sure that they understand and document it, as HC said, going back to not just the TP documentation, and we know our reports look great, nice and glossy, but we want you to have all of that supporting information, and we can certainly help with getting all of that together so that you've got that in that framework there, especially as HC and I have had a few reviews recently where, the staff changeover at the companies have completely changed. Now, we were fortunate that we had very clear processes together. And I think some of them Kevin and I had set up like 8-9 years ago of this is the process that you need to do, and your finance team needs to do this every year, and they need to save these files and link it all through. So we can have a complete changeover of staff at the company, go in, and they're still following our processes. I think there was one that's under review that Kevin and I did the process like 9 years ago, and they were still following it. So we had that full information, and the planning is going to be, critical from that perspective. You want to be proactive. There's too many changes coming up for you to just wait till after year end, and then 6 months after, a lot of people call us 2 weeks before lodgement and say, hey, we need to make sure that this is all correct. We're going to need to do this a lot more in advance and get that done. Especially, what about the intangibles? If you've got, though, there's going to be some restructuring that's going to be needed on that side of things. So definitely recommend, takeaway is to make sure that you do plan and try and get that framework out there. Now, I'll just check if we've got any questions. We don't have any questions. If anything, any questions come up?
And so far.
Yeah. So we must have answered everyone's questions, and everyone stayed on. So that's a good thing. If you do get any questions, do come back. We can come back to us. We can help you with, your global transfer pricing documentation, master file, country by country, local documentation, regional. We have our offices in Singapore and Malaysia, but we do have the global databases as well. We can also help you with the transfer pricing legal contracts. They're becoming so important now. Now that we've got all the lawyers interested in transfer pricing, before that, our legislation was so small, and now that they're all involved, and then also the benchmarking. And as we mentioned earlier, Kevin talked about, Netflix, you've probably seen every video by now on Netflix, every series. We've got the transfer pricing series, I guess you could say. So we do have a number from webinars that we've done over the past year hybrid mismatch, country by country reporting, the MOLA, transfer pricing documentation, transfer pricing methods, international dealing schedule. So go to our, if you have a look, there's also a number for Singapore and Malaysia as well. So in the Asian area as well as Australia, but take a look at our YouTube channel. That'll keep you entertained and out of trouble on the weekends. And then if there's any topics, please do reach out to us if there's any topics that you would like us to cover. One of those was a suggestion from someone on our webinars on the hybrid mismatch. And we were like, well, hybrid mismatch, it's kind of transfer pricing, kind of international tax, but hey, we'll do it. We started to do a lot more on hybrid mismatch as well. So we did the webinar on that too. So if there's any topics, we are planning to look at doing TP 101 workshops next year. I know we kind of said that last year, and then I don't know about everyone, but the beginning of this year just went crazy with the whole COVID thing. So we're going to try and get back into those TP 101 workshops as well. But let us know any particular topics you would like us to cover. And feel free to reach out if we can help you at all. But I guess key message to take away, make sure that you're planning and thinking about what's happening on transfer pricing. Don't just wait till after the year end. But thanks very much for joining us, and we will catch up with you all soon. Thank you.
Thank you.
Thank you, guys.